Hello, hello, hello. It is Stephanie Deeds, your favorite realtor here at the Deeds Group at RE/MAX. And I'm coming at you today with our most recent episode of Did You Know with the Deeds. So today, our Did You Know topic is going to be buyer closing costs. Not just closing costs, but costs associated with purchasing a home. So a couple of different things I want to address here. First of all, it is a common misconception, I think, that in order to purchase a home, you have to have 20% down. 20% is a lot of money. On a $200,000 house, we're talking $40,000. There's not a lot of us that have that kind of money sitting in our savings account. So just so you are aware, if you would like to purchase a home, and you can qualify for an FHA loan, which is actually one of the easier loans to qualify for, the minimum down there is 3.5%. 3.5% on a $200,000 house is a little over $6,000 rather than a $40,000 down payment, okay? So also you can do a conventional product with 5% down. So really there are some more affordable ways to buy a house. Now your down payment though is not the only thing that you have to be concerned about. There are other costs, of course, associated in purchasing a home. You're gonna pay for a home inspection because it is very important that you make sure you know what is behind the walls, what's kind of under the hood per se of the house. So that is probably gonna run, depending on the size of house, between $300 and $500. Somewhere in that range is what it's gonna cost you to have the house inspected. Also, if you're getting a mortgage, you're gonna have to pay for an appraisal. The appraisal is typically around a $500 expense. So the appraisal is where an appraiser comes out and he or she determines what market value of the property is. Now, as your agent and as the listing agent has priced the property on the market, and then as the buyer's agent, I have advised you on what we believe is a fair price. The appraiser basically has to agree with us in order for the bank to lend us the money we need to get the mortgage, okay? So a couple of checks that you're going to have to write as soon as you decide to go under contract on a specific home. You're going to need an option check and an earnest money check, okay? I'm going to explain what both of those things are. So the option check is for the option period. What that time frame is in the contract, once we go under contract, we have a 5, 7, 10-day window. The number of days is negotiated in the contract, what the buyer and seller agree to. Typically, your option fee could range from $100 up to $500, depending on how competitive of an offer we're talking about. If you're in multiple offers, that number is going to be higher. If you're the only offer, you might get away on a little bit lower end there. You are paying the seller for the time to have the house inspected and for the opportunity to negotiate repairs, okay? So if you decide that you want to terminate that contract within that 5, 7, 10 days, whatever you've agreed on, you have the unrestricted right to back out of the contract, okay? You don't have to find a reason in the inspection. You can just back out because you paid your option money, okay? If you do, seller keeps that $100. If you don't back out, if you move forward, that $100 will get credited back to you at closing, okay? So in addition to the option check, you're gonna write an earnest money check. The earnest money is a little bit more substantial. We're talking about 1% usually of the purchase price. So on a $200,000 house, it would probably be about a $2,000 check. Now that amount is also negotiable between buyer and seller in the contract, okay? What the earnest money does is it goes to the title company. The title company is the third party, disinterested party that isn't on the buyer side, they're not on the seller side, they are a neutral third party. They're gonna hold the money until they're told what to do with it. Most of the time, 99% of the time, when the buyer moves forward, that money will just get credited back to you. You're gonna have all of your closing costs and your down payment, everything that you owe on closing day, your earnest money is gonna be a credit back to that amount, okay? If for some reason you default on the contract, if you don't close, if you don't have a contractual reason to terminate the contract, then that $2,000 is very likely going to go into the seller's pocket. Again, buyer and seller have to agree how that money gets distributed, so I would say that's probably one of the more common places you see small claims disagreements in court, trying to determine who gets to keep that money. But let me just say this, most of the time, we are going to have a very smooth transaction where the checks get delivered where they're supposed to, the inspection happens, we negotiate repairs, everybody agrees, we have an appraisal, and then we close on a house. and all of the money that you spent goes where it's supposed to go, gets credited where it's supposed to get credited, and at the end of the day, you have a brand new, beautiful home that you are thrilled to move into. So I would be more than happy to talk to you about your own specific situation as far as what kind of contract would be the best for you, how much down payment you might need. I can get you in touch with my mortgage lender, and we can talk about all of this in more detail, because I may have made this clear as mud. I'm not sure. So if you have specific questions, I would be more than happy to answer them. Please call me, text me, post a question here on this video on our social media. Follow us here on Facebook, Instagram, anywhere you can find us. We'd love to see you. Have a great afternoon.